Hi there, everyone. Fantastic to be here at Cybos and specifically Tribe. I feel like we should have a bit of a dance after that music lead-in. I'm really pleased to be facilitating this session, although I'm very aware that the five of us up here are standing or sitting between you and a beer. So we will make it compelling. That's a promise. Thanks for being here. So FinTech, a sound investment strategy, or would you be better putting it all on red? Now, it's at this point I wondered whether I should admit to having absolutely no idea if this image behind me is blackjack, roulette, poker, or 21, or if all of those are actually the same game. So not a gambler, but anyway, we're going with a gambling question. I digress. Kicking off, just a little bit about me. I am Chloe James. I'm the Global Media Director for RFI Group. We're a global financial research business focusing exclusively on financial services. We operate in 44 markets around the world and interview over 500,000 consumers and 500,000 businesses every year about their relationship with their banking product, providing insight for their business strategy. I'm also a presenter for Sky News Business. My shows have a specific focus on entrepreneurs and successful businesses, and more recently, FinTech, because those topics seem to be going very hand in hand at the moment, as I'm sure you would agree. Basically, every day I get to talk to global leaders on live television about what makes them tick, what makes their lives and careers often a very blurred line. So exciting. And one of the hot topics we always talk about is, of course, investment, which is why I guess I got this gig. As my family would willingly tell you, I've never been one to shy away from a debate, a healthy debate on pretty much any topic. And I love this one. So we, of course, are likely to hear arguments on both sides. Maybe that's why they popped me in the middle here. So we're going to get into FinTech, of course, for me, is a sound strategy for investment. Otherwise, I'd probably be out of a job. So it seems to make sense. I thought I'd give a little bit of context from an RFI perspective on FinTech, and why not start in Australia, my home market, in case you couldn't tell. G'day. In the last 12 months, our research has witnessed incredible FinTech usage, going from 0 to 5%. So although that's obviously coming off a very low base, it's really significant. In the last 5 years in Australia, we saw very similar statistics when it came to contactless, 0 to 5% in 12 months. And now 5 years later, we're at 70+%. So huge saturation, obviously, in a very short time. As far as the way the industry is evolving and maturing, we have a global digital banking survey and report. That's something that we've run every 6 months every 6 months since 2012, which is also showing some really startling statistic when it comes to digital and it comes to FinTech. In the edition that came out just 12 months ago, in 12 months alone, our research has seen a 20% increase globally among consumers who are comfortable with the idea of a digital-only provider for their financial services. That's up from 60 to 80% globally. Again, in the last 12 months, we've seen a stratospheric growth in the usage of FinTech services and providers. In most markets, it's somewhere between 300 and 500% in 12 months. Some markets, like the US, for example, 40% of consumers are already engaged with a FinTech provider of product or service. So there are some numbers from me on the consumer side. Hope you were listening. There will be a test later on over some drinks. But without further ado, I'd obviously love to introduce my panel, who know pretty much everything there is to know about investment and FinTech. No pressure, guys. The who, what, when, where, why, and how. So the way I love to kick things off, people always introduce themselves better than I could introduce them. So Victor Baster's going to begin, and we'll go around the table. I might just make a note here on his collection of rock and roll posters, but tell me about yourself, Victor.
All right, well, that's not why I'm here. I help run Magister Advisors in London, and so we helped Nutmeg last year raise the largest FinTech round in Europe, and we're hopefully going to close we think is going to be the largest ever FinTech raise in Africa this year. So we are very deep in FinTech. We work with later stage growth companies and people who are raising larger rounds and also looking at exit. So we must see hundreds of international FinTech companies every year, evaluate them, work with some of them, and we have a view about all of them.
Fantastic. And next, Ian Polari, fellow Aussie on my left.
Hi, Chloe. Good afternoon, everyone. So my name's Ian Polari. I co-lead KPMG's global FinTech practice. Our FinTech practice was established around 3 years ago, now comprises of partners and directors in over 35 FinTech hubs around the world. We work from the likes of the small startups through to scale-ups, the financial institutions, governments and regulators, so the full spectrum of key stakeholders in the industry. I personally do a lot of work with FIs, but also help a number of the startups raise capital as well.
Fantastic, thanks Ian. We'll go over to Mike. Interesting kind of differentiation here between the bigger business and the startup. Biggest startup man in the world. Hit
Yeah,
me?
and forgive me, everyone. I'm just getting over a cold.
He's been partying, but anyway.
Yeah. My name's Mike Siegel. I'm a general partner at 500 FinTech, which is an early-stage venture capital fund based in Silicon Valley. But we invest globally. We're the most active early-stage FinTech investor in the world. We have over 220 portfolio companies in 26 countries. At the top of our portfolio are companies like Stripe and Credit Karma. Our investors include high net worths, family offices, and corporates who are trying to leverage our expertise in early stage to be able to scan what's going on 3 to 5 years out.
Awesome, thanks, Mike. And Andrew Martin, Andy?
Hi, I've been on your side of the fence because I was a banker for 5 years in leveraged buyouts and project finance, then moved over to captive VC and private equity. Since then, I went on to, my partner at the time said I've come away from the dark side, and I spent 5 years as a chief operating officer of a startup, so I've done everything from order the first pencils through to the first server and that sort of good stuff. Since then, I've been chief financial officer of a fintech fund, doing all the stuff behind the thing and letting the guys like these people go and find the deals. I tied them together. And I currently now sort of work with 1 or 2 companies a year, helping them raise funds, making sure that they've got everything in order in their back offices so that the likes of Mike will like them to come through the door.
Fantastic. So just a little bit of experience around the table. So we're gonna dive right in. FinTech, as I said, a sound investment strategy, or would you be better putting it all on red? The huge $64,000 question. Within this session, we're going to cover a few things. We've met and discussed some of the bits that we'll cover so we can really deep dive into some topics, global perspectives, investment, of course, the culture of a business. I think a fantastic topic, one of my favorites to talk about actually, scale and growth, leadership, getting that sort of balance right, partnership, another huge piece, education, misconceptions when it comes to fintech and investment, and the next big thing, why someone might not be here next year because they've just found their next $10 billion company. We'll get to that at the end. So we've got about 45 minutes. We will ask for questions from the floor. I've got a couple of questions preset, so they'll come up behind me with about 15 minutes to go, and then we're going to have some roving microphones. So jump in, get involved, grab a beer, and sort of we'll go on with it. But I thought we'd just start with global perspectives and a global view, a bit of a state of play. So the current state of play for fintech in your market or region, or regions, if we're talking globally. Do you want to start off, Victor?
Sure. Well, it's hard to encapsulate everything in just a couple of sentences, but I would say, well, the market is very hot. If you're looking at it from an investment point of view, if you are running a fintech business or already invested in a fintech business, in many parts of fintech, it's a great time to sell equity in whatever form and raise as much as you can. Yeah. Many companies are what I'd say over their skis in terms of valuation, being valued at 100, 200 million when they have a few million of revenue and have an awful lot to prove. And I think it was Slack's CEO a few years ago was interviewed and said, why did you raise 200 million bucks? And he said, because I could. So I don't mean to kind of just make it oversimplified, but it is a very hot space. The other thing we see internationally, but also in the US, is that it's starting to migrate more towards a corporate investing market. So in Europe, the larger rounds, so we define larger rounds, the kind of we work on 25 million and above in size. Half of those rounds now involve a corporate. Yeah. 3 years ago, it was 15%. Now, corporates don't lead rounds generally, but they are very, very involved. And so that sets a stage for partnership, but also sets a stage for the migration of the market, migration of funding towards really corporate-driven investing. And there are a bunch of reasons I'm sure we can explore for it. But at the moment, the corporates, of course, don't mind, if you will, higher valuations. They look at it over a 10-year time frame, not a 3 or 4 year time frame.
Yeah, well, I do want to talk about the time frames in a minute, because we've discussed, as we discussed yesterday, some of those sort of early stage, and then where do things go 10, 20, 30 years. Bringing in the corporate piece then, Ian, did you want to add anything from a KPMG perspective of perhaps some sort of big global trends that you're seeing?
Sure, and I think just to echo Victor's comments, we've seen this transition of investment from VC to corporate participation. Most of that is actually coming from Asia, which is interesting to see that the Asians are coming in pretty heavily with strategic investment. The rounds are getting larger. But at a big picture level, if we compare where we are now to where we were in 2008, so just shy of 10 years ago, there was around $100 million invested into fintech. In the last 18 months, there's been over 27 billion, so there's been a lot. We have seen some of of the frothiness come out of the market, which I think is important to put it on a more sustainable footing. And it's interesting where the capital's been going. Historically, there's been a lot of capital deployed to lending and payments, which has typically attracted around 60 to 65% of investment. A lot of that has been directed towards the Northern Hemisphere. I think the big shift we've seen, perhaps tying in more of an Asia-Pacific perspective, is the participation of the Chinese. And certainly when we look at the unicorns of a more contemporary context, they very much feature at the top of it. And what's interesting to observe now, as we look at the BATs, as they start to extend, they're looking to extend by virtue of investments and acquisitions outside of their home markets, which are trends we expect to continue.
Yeah, fantastic. I mean, that global view, from your view then, Mike, I mean, what would your view be there?
I guess in the big picture, this transformation that's going on in financial services is truly global. There's certain differences from market to market and regulator to regulator or regime, but fundamentally we see everyone moving in, roughly speaking, the same direction. We also see, both from our corporate LP side and the partners that come and talk to our companies, I think globally about 32% of all venture into financial services transformation is coming from banks and insurers. So that's a big thing. We also see that we're beginning to move past the point of POC-based innovation theater into actual deployment.
Yeah, absolutely. Who are driving the choices when it comes to fintechs that we need? Do you think it's sort of business, industry, policymakers, government, customers? Andy?
Ooh, that's a tough one, isn't
Round
it?
to
Thank
you.
you very much for that.
That's all right.
Yeah, I mean, I think a lot of it is driven by or has historically been driven by the VC community. They raise the money, it's got to go somewhere, and they try and work with trends within the industry. And we had this discussion the other day about where would you put your money now? And the thought process we're going through is, would you invest in a lending platform or a payments company? And I think my personal view would be absolutely not. It's done. So where would you go and look for? You try and see the trends that are emerging and actually go behind that. There's a funny sort of mix between that, because as Mike pointed out, Victor pointed out, you have the corporate investors coming in spades. I mean, I did a round with one of the two companies I advised this year. Our ask was 5, we raised 9.5, and it was led by a Japanese investor, a corporate investor. Yeah. So it's tough to say which is which, because the corporate investor came in, but the VCs came behind it. And I've seen the other way around as well.
So we're not taking turns particularly, but I did want to jump into 2 observations. One is that if you just look macro level, generally VCs have underestimated the amount of time and runway required to build a quality fintech company. 3-5 year time frame doesn't work when you're trying to fit into an ecosystem with people who think in 10-year cycles. And so building a digital insurer from the ground up is a 20-year exercise, not a 6-year exercise, et cetera, et cetera. And so it's a natural migration where I think it becomes less and less of a VC game for those reasons. The second point, again, putting everything in context, is picking up what you said. So I read an estimate not too long ago, it might be right, might not be right, but it's probably directionally accurate, that there's $20 billion a year wasted in financial services IT. Wasted. Right? Annual funding in fintech is about $20 billion. I mean, so if you put it in context, we think, my God, it's gone from nothing to a lot of money. Relatively speaking, if all you did was just recycle the waste, the amount of productivity you would be able to get. And again, just putting it into sharp context of, relatively speaking, how small it still is. But even having said that, it's already shifted from being a VC-driven game, even though VCs have made decisions, of course, by definition, over the last 5-6 years as to which companies to back, which is why I've seen so many B2C companies, which you won't in future, but it's a separate topic.
And I think when we look at, I think a number of corporates or banks that are assessing investments into fintech, I think they take a step back. And, I think the important point here is that there's probably a third to 40% of financial institutions who understand that the change that's occurring is structural in nature. There's probably a third who think it's, Y2K and cyclical. The reality is they'll be challenged fundamentally, and it's a question of how slow or quick they are to respond. And there's probably 30 to 40% who recognise it's structural but not sure what they should be doing. And most FIs will be going through some form of large-scale transformation. The reality is those transformation efforts usually come with $1 billion plus investment, to contribute to the 20 billion. And we know that they're sort of 4 to 5 year journeys in the context of really harnessing any value to the organisation. So in today's age, with the world moving so quickly, that's putting a bit of a red play down, because you're recognising it's a 5-year journey, transformational in nature. I think a lot of boards and management teams really recognise that, are we sure we're going to get to where we need to get to at the end of the 5 years, and the world hasn't sufficiently moved on, that we need to spend another sort of $1 billion plus a year and another 5 years to go on another transformation agenda. So the hedge against that is putting down a series of small bets, and that's what's sort of informing corporate VC participation in investments in a range of smaller companies. And the reality is, even that is going to take time to really pay off and determine where the winner's going to be. There'll be some failures. I think most of them accept that. But either side of that equation, we're talking about at least a 5-year time frame to work out where the winning play is. And I think what's going to inform their strategies moving forward is, well, what do you do to insulate yourself against disruption to sort of immediately realise benefits? And I think that's going to inform certainly a trend we're seeing, where FIs, and this won't be just FIs will lead it, but they'll be working with other scale providers to get to dominant scale positions in a particular market opportunity. It's certainly a trend.
Do you think
we're
that's
observing.
acquisition and partnering?
I think it's going to be more partnering. We're seeing that already. You look at examples like Zhong'an, which is a very well-noted one. I know it came up in previous sessions in InterTribe. You have 3 organisations, 3 incumbent players with 3 different sets of capabilities and assets coming together to realise an opportunity around online insurance in the Chinese market, and they've been able to get to a dominant scale position very quickly. That's fintech. It might not be a fintech startup, but it's recognising there are 3 scale providers from different areas coming together to capitalise on a market opportunity.
I think we'll see it in lending as well a lot. We were sort of discussing in Australia, certainly a lot of those lending platforms, whether they will all just come together and dominate and take over.
We're seeing in the US that consolidation happening already. I think the interesting element around lending is how FIs can orchestrate, either through partnerships or investments, a more holistic proposition around, let's say, the end-to-end home buying experience. We've seen from our market in Australia, where the National Australia Bank has announced a partnership with realestate.com, which is an online real estate search business, because they know that is very much the referral to lending, and they're looking to orchestrate. Yeah, that's going to give them a lot in the funnel, and it's going to start to provide, I guess, a response to the various friction points that exist across that buying process for consumers.
So just to add something, maybe before you move on, this is a two-way street in that a lot of reasonably built fintech companies have to have strategic partners in order to succeed. I'll give you one example. So customer acquisition costs.
Oh, yeah.
So we looked at 4 companies in a space, and 2 of them you would know very well, looked at their plans, because we said they were looking to raise larger rounds. Every single one of them was going to raise between 25 and 100 million, and every single one of them had a forecast of flat customer acquisition cost. Every one of them, right? All 4. In fact, one of them had it going down.
Yeah.
Right? And they're all competing in the same geographic market. It's just not going to happen. Right? It's going to go absolutely one direction. And so if you're able to partner with somebody who has a plethora of customers, but doesn't innovate, this is like manna from heaven. That's the way you can slash your customer acquisition costs to get a partnership going right. Now, it's different in different markets, and payments is different than foreign exchange, but that is just one very compelling example from 2 weeks ago. It's a very live topic, and our view is it becomes mission critical for many fintech companies who are mid-stage growth, no longer elective, and it's just as important for larger companies, right?
Yeah. You see that happening in quite a few fintechs, where they started out as a B2C sort of environment and suddenly, whoops, got this one wrong, quick pivot, go straight to B2B, because they are lumpy enterprise sales, but when they arrive, the cost of your acquisition with customers is a hell of a lot lower than trying to do it the hard way.
When all the funding comes in, I want to bring Mike into the conversation. I want to talk about where that allocation, of funding goes, and how the business then looks, and then I want to talk a little bit about culture.
Ask me that a different way.
I just thought it would be interesting to talk about the allocation of funds when it comes to strategy of an investment.
Sure. So I think it was brought up just a minute ago about wouldn't invest in payments, wouldn't invest in lending. The issue is those were the early low-hanging fruit in this industry. And when we, as a very early stage investor, look at the context of the market, we try and look for white spaces elsewhere in financial services. So although we don't see anything in payments directly, in lending directly, we do see lots of stuff in credit scoring. We think that the capital market stack is underinvested so far. We see that a lot of insurance is still underinvested. And we begin to look for derivative opportunities from things that have already come. So I wouldn't invest in a payments company, but a company that's leveraging payments data to do fraud detection or customer acquisition
like
or
secondary.
these kinds of things.
Yeah.
There's a lot of that, and I think that's why we're at the beginning stages of what is a generational change in financial services, the way financial services is delivered. FinTech is just the hashtag that we use for naming what has already happened in media and has already happened in telecom, has already happened in retail. Now it's happening to financial services.
And you mentioned yesterday that we're just sort of scratching the surface there. You think there's a long way to go?
Oh yeah, I mean, there's a table that I use to show who is the top performing companies in retail, telecom, media from 10 years ago versus now. And in most of those industries, the top positions are owned by new entrants. The next positions are owned by those companies who have really embraced how things are transforming. And all of those industries are smaller than financial services, than even subsets of financial services. So I think we're in very early innings. Not that it's not self-serving for an early stage investor, but right.
And Mike, what role do you see regulation playing? Is that a sort of a barrier to some of that competition that may emerge, or do you see that as an opportunity as regulators look to stimulate competition in certain markets?
I think this is a really different market than many others, right? I can remember, and I'm sure you remember, there was all of these places, all over the world. Yeah, it's not because we're that old. That wanted to be the Silicon Valley of whatever, right? And now we have 44 FinTech hubs. And what's interesting is that everywhere there is a conglomeration of large financial institutions, there's an opportunity to create an innovation economy. And we see, places like Singapore and London and Hong Kong and others actually trying to lead as opposed to be a laggard, not because they want to compromise safety, but because they know they need to make some changes to provide the consumers the services that they're demanding.
Well, they're under they're sort of putting the pressure on the traditional organisations and really supporting FinTech to offer competition.
Well, you look at Singapore and what they've basically done is create a level playing field.
Yeah.
So I think the nature of exits and the nature of partnerships are very much controlled by regulation, right? Is customer acquisition. But I don't look at regulation as a blocker, well, except for in the US.
Well, the issue though, I mean, it cuts both ways, right? So regulation stroke compliance, if we touch on that. So we can talk about it for hours and hours, but it is a very double-edged issue with a lot of FinTech companies. So just as an example, so if you look at the top 50 FinTech companies in Europe, there are 5 we know of that will not survive a DDoS attack. Right? It will bring the whole thing to a standstill. They just don't have the systems in place to survive. Now, they may be able to come back up in due course, but when it's a trust industry, that's a serious issue. Now, that's 5 we know of. I don't know how many there are. And so while there's a very strong partnership and cooperation with regulators and compliance, and a lot of these companies are taking people's money, the reality is when you look at the tech stacks and how rapidly they've been built, and the issues that they have to solve, these companies all face effectively a rebuild over the next few years. And yet they are they're compliant and regulated, sandbox or otherwise. Yeah. So, it's a very double-edged thing.
But I think it comes back down to getting to dominant scale, and we've seen in the UK market, Andy, I'm sure you've got observations. We've had 50-odd licenses granted by the authorities there, but the reality is very few have actually got to a dominant scale position, and ultimately you've got to make money. And it's all very well having mobile apps and capability that consumers want. You get an early level of adoption, but unless you've got fundamentally, value that's being created that you can realise, very hard to see that being sustainable and credible in the context of delivering competition.
Yeah, I mean, the UK market, in that sort of, if you're talking about sort of the neobanks, there's a huge amount of what they call the freemium approach to selling services, which you used to see in mobile when it first kicked off, which I'd spent too much of my time in, everybody was given a free handset. But fortunately, when you only had 4 operators in the UK market, so when they decided that the freemium model didn't work, everybody sort of came to their senses and put it down into an orderly situation. Here, if you've got 10, 15 players all playing the freemium model, all trying to get their customers up as quickly as possible, how long can it survive before you have to monetize? At the moment, the people who are monetizing are actually the VCs or whoever behind them throwing the money at the companies. You know, at some stage that you've got to prove that your model works and it can actually start generating cash. And I think that's one of the problems you're seeing when you get people jumping into the same space all the time. And crazy valuations as well, which just almost becomes self-feeding.
Well, I think that's the point that we're at now in the industry, isn't it? And one of the points of this panel today was to talk about who is actually sort of bringing those products and are they lifting and being in market.
Yeah. I mean, who's bringing the product in market? I mean, there's the whole, you talk about fintech, there's a whole bunch of different bits of it. I have for me, there's one thing which you think is nothing to do with fintech, but it actually should be very central. I mean, you think about the PPI problem in the UK. Major blunder, all the rest of that. The banks there are spending a fortune managing their way out of the hole. In terms of dealing with all the complaints, etc., it's massive call centers. If you digitized that and made all your complaints go straight through an email system, etc., there is a company that does it that reckons they can cut the cost of the complaint system by over 70%. Now, if that had been put in place, the banks wouldn't have the provisions they put in place. They'd probably slash them in half. That, to me, is a fintech company, even though it doesn't deal in what you would think of financial services.
Yeah, I mean, it's interesting you talk about taking the call centre out. I met with the ex-CEO of Barclays in Sydney the other week and in Singapore last week, and he was talking about how he went and spoke to all the call centre people, and they were sort of advising people to go online, and they're never going to be the people to say that or promote that because that cuts them out of a job, right? So that changes traditional industry, a lot of the people that I speak with.
But then I've seen the other side of that, which is when, in a retail play where, there was a big problem was when you get to your basket is full and you're going to check out, and then suddenly they just decline, they don't go through. And there was a company that spent its time actually doing a conversion, and the conversion was done by having a telephone call come into the guy, got to his basket at this stage, and the conversion rate from a phone call or something actually brought the conversion rate up by 12 to 15% because of human involvement. Yeah. But it's the point at which you bring it in that I think is important, how much of a resource you need for it. But it does work.
Yeah, I think if we maybe go back, link that to investment themes, I think if you look at it, and we're kind of being negative about a number of things, but there's some great fintech companies being built. I mean, there's Adyen, which everybody knows about, of course, SoFi, which is really very profitable, Backbase, which is out on the floor here, and a number of others. So, fintech has succeeded, right? One of the issues, though, that we find is that the market is at a relative stage of hype where companies that haven't succeeded get valuation discounts that are very small relative to those that have. Yeah. That's the issue. The issue is indiscriminance, not fintech is, overrated or whatever. It's that indiscriminance that cuts across every segment of fintech, and that makes it very hard for people to really pick winners, right? Because a lot of people look like winners. And to be honest, it also makes a number of larger strategics, it finds it more difficult for them because, a lot of people are doing the same thing. There's a lot of noise. And, you want to be able to place various bets, but you are, the gap between number 1, 2, and 3 ought to be like 170-30, and it's 195-90. Yeah. That's the problem.
Well, I think that's part of what makes financial services different than markets that have come before. I mean, this is a much larger industry. It's a much more fragmented industry, both across subsectors and size of players. So I think the notion, right, again, self-serving, is of winner-take-all in financial services transformation doesn't exist, right? Everyone in this room is going to need different customer interface, different cybersecurity, different whatever than they have today, which means that there's lots of space for both lots of companies that you're going to acquire, and whether it's existing service providers, right, an IBM or an AWS or whatever, or a new provider, you're going to need to buy from them to transform your business.
I think it's interesting you talking about hard to identify. So then how do you all identify the winners? Like, how does the cream rise to the top and you
dartboard.
Pick a winner?
Dartboard and
it's very hard. It's very hard. It's very noisy. Market. So you would parse it at a high level between what I call single product and then broader functionality companies. So the biggest thing to watch out for is single product, single market, $300 million pre-money valuation.
Scalable. It has to be scalable.
God bless you.
Yeah.
Great. You're not a company, you're a product, right? And every one of those guys, and the other thing to watch out for is when somebody says they're a platform. Okay?
That's a buzzword, isn't it?
You're a product. Products aren't worth $400 million. And then you get into companies who actually broadened out. SoFi is a very good example, right? Starts in one part of the market, broadens out, and by the way, they're now worth serious money, and they deserve to be worth serious money. And so a company's ability to be able to broaden itself beyond a single offering. The digital banks are a very good example, right? All they're doing is selling a very simple bank account to as many millennials as they can. That doesn't prove anything. No. I mean, we could buy a bunch of millennials over a weekend. So the point is, that's fine. They're worth maybe 30 million because nice try, they have a nice stack and whatever, or maybe 50, but not 400. That's the point. So if you want to be lazy, and everybody's lazy, you would immediately parse it to single product, who's worth triple digits, and who's already multi-product. And that already will cut out 70% of the crap. Sorry.
And I think from a corporate perspective, advising a lot of FIs, I think really what delineates between those that are leading and those that are in the middle of the herd is a real clarity around their fintech strategy and whether it's sort of fields of battle or some chosen areas they want to focus on. I think that's important because there's a lot of noise, and most big FIs are getting 3 or 4 fintech companies knocking on the door every day. So it's really important those FIs have identified those 5 or 6 areas that's where they want to play, and that's where they're going to win. And it's a question of how a fintech company can be a part of accelerating or strengthening a winning position in those areas. I think that's really important to get that clarity. And we launched a report today which showed that of the 168 FIs we've surveyed globally, that only 46% of them actually have a fintech strategy in place, and less than half of them they would suggest are aligned to the corporate strategy. So there's a lot of work to be done in the context of FIs getting very clear around where they want to play and how they're going to win.
Yeah, and is it also, I mean, we discussed it yesterday, but is it also the person that's sort of at the helm? Like, is that person important? And we were talking about, do you go for a tech Silicon Valley person coming out, or would you prefer someone who has that real financial services knowledge and is sort of in the background?
In the corporate or in the startup? Right?
In the startup, let's just go there.
I mean, in the startup, I'm biased, right? Because I do think most startups are going to need relationships with the existing industry to create an exit for me. So I'm biased towards a team that has a balance of came from the industry and came from Stanford's engineering school or something like that.
Yeah. I would totally agree with that. I mean, you see with one of the startups, she's working with blockchain for the quick, I forget what they call it, the rapid traders, where the settlement has to be almost a minute. She came out of JP Morgan's, was one of the leading lights in default swaps. So, there you have the classic. She's moved from being innovative in a financial service institution into being, the CEO of an early stage startup.
That said, regardless of whether you're in a corporate or in a startup, you need someone leading who is going to defy gravity, who's going to get up every morning and run through a brick wall, because one way or another you're trying to change the world.
Yeah.
And it's going to be hard.
And there's that entrepreneurial street person.
So your question's a very hard question. So, I mean, we see these companies.
I love the hard question.
200 people or something, right? So their culture is built, et cetera. So, and the question is, if they were started by, and the DNA was financial services, what do they look like? And if they were started, the DNA was tech, what do they look like? So, and you really see the differences. I mean, so let's start with a couple of negatives. Is if they're run by financial services, typically they're built to Deutsche Bank standards, right? When the company's tiny. I mean, just the amount of money they put behind, redundancy of systems, et cetera, is out of all order to what the volume is that they have. They need to be ready for any eventuality, which is also great. Run by tech people, and it's exactly the reverse. I mean, one of the reasons why these companies that I mentioned before won't survive a DDoS attack is, again, because they are run by people who are kind of put it together, ramp quickly. Net, I would probably err towards financial services, net, just because it's a trust business at the end of the day. And it's hard to hire great people in certain functional areas if you're really a tech company, meaning compliance in, these kinds of areas. It's hard. The culture needs to be able to embrace that. And the culture needs to embrace slowing down when you need to get things right. And if it's really driven by kind of a B2C tech culture, to be extreme for a moment from the beginning, it's hard to get that, and typically those sort of people are harder to fit into an organization.
The funny thing is, our companies, and again, we're very early stage, they are having a remarkably easy time finding really good financial services people who are bored out of their minds in what they're currently doing.
Because they feel restrained in everything they're seeing and reading. They want to be involved.
They want some excitement. They want, right? So,
Well, we've just seen
but
so
we'll
much-
see. Again,
Yeah.
none of mine, with few exceptions, are big enough to know whether that works.
You see too much tissue rejection downstream.
Yeah.
That's the problem.
Oh, fair enough.
When somebody says, look, we need to spend $6 million in order to fix this, and the tech team at the top says, you've got to be kidding me. That's $6 million we could have spent on customer acquisition.
Have you ever seen any massive culture clashes?
Oh, God.
Okay.
Oh, there's going to be a few.
Okay, shoot.
There's going to be a few.
Give us some, 'cause I think it's interesting.
Just think about this. There's a neobank, German, that was bought by a French major bank. The culture clash between the CEO of that German bank, which did a fantastic job, don't get me wrong, he's brilliant, but he's one of those guys who just runs through brick walls. Now, how that sort of culture is going to fit with a large French bank is going to be very interesting to see how that pans out. It's different, but it needs managing. And what you don't want to have happen is that the large institutions suppress what made them buy that company in the first place. That you've got to actually be able to adapt, but that means it's all across the board. And give you an idea, I went through two money center acquisitions actually in-house, and the cultures, when you were even between banks and they're doing the same thing, the two different cultures coming in, it was like you wouldn't believe it. But that's doing the same thing, bringing in an early stage consumer bank on one side and putting it in with a traditional consumer bank on the other. That's major in terms of sandpaper and potential.
Where you see the culture clash, I'll give you an example. You have a CEO who is a technology person, but is mature, grown up, et cetera, driving the business, really focused on marketing. You have a COO, comes from financial services, right? Everything's fine until you hit a rock in the road. Okay?
Yeah.
And then what happens, right? What often happens is the COO wants to be CEO, and as soon as you hit a rock, says, well, we wouldn't have hit that rock, ... And then you have the split in the company that happens, and if you don't manage it properly, you have two camps quite quickly. And when you had people collaborating before, I've seen it in a month or two, because of some major issue, and they literally have two different worldviews about the same problem.
Yeah.
Plus, you of course get the ambition and jealousy factors, which hit every company. To bring it back up, the melding of those two cultures when you're ramping a business at some scale is probably one of the most underrated risk factors in fintech companies across all functional areas. And it's something that a lot of investors don't really pay attention to, because when they invest, they normally come from the tech industry, investing in fintech. They don't really think about it. Well, hire a compliance person. Need one, go get
This
one.
is exactly how we determine who we want as follow-on investors in our company. If they get that, right? If they've been investing in fintech, they get that.
Yeah, but
I was going to suggest, I think FIs are alert to that risk of cuddling the baby too much too early, and everyone's getting a chance to hold it. It's kind of sort of not going to end in the right sort of place. And I think we're starting to see those leading banks who recognise if they're going to acquire a business or bring on board an entrepreneur, which is another dynamic we're observing, that FIs recognise there's a market opportunity. That market opportunity can be best realised not by deploying someone that's been in the organisation for 30 years, but actually bringing in an entrepreneur with the right skill sets, but giving them the right level of empowerment, investment for them to create a new business, but doing that outside of the organisation with the right support, of the management team. And I think that's an important element of it. I think FIs are attuned to some of the challenges that perhaps have held them back historically.
Yeah, I'm conscious of time. These things always just sort of fly by. I just want to touch very quickly on RegTech, because we talked about it yesterday. I think it's a huge space, and I guess that may be a little bit to sort of where we're going next. But your view on that as an area?
It's a big problem to solve. I mean, if we look at today, banks and insurers, asset managers are collectively spending $90 billion a year on risk and compliance. That's predicted to rise to $120 billion over the next 5 years. So I think the key thing is that this is a permanent fixture. This is not we had the GFC, we responded, and now we're coming back to some sort of new normal, which looks like significantly less costly than what it was after the GFC. The reality is that cost is going to remain significant. And the reality is a lot of FIs, and they may be different in different markets, have thrown bodies at the solution to get over some of the imminent questions they needed to resolve, whether it's cultural or harder in terms of regulatory compliance. So that is a massive issue for the industry. It's not going away. So you recognise there's a lot of RegTech players that can actually look at that. And if we look at the investment in RegTech, it's growing quickly. Already, so the sort of first 6 months of this financial year has exceeded the level of investment last year. So it's around $590 million in US dollar terms, and last year it was sort of 550. So we're well on target to break a record as it relates to RegTech.
Yeah, well, I mean, in the fintech space, that's the thing that's going to take the pain away and make the businesses grow quicker. That was the kind of conversation we were having yesterday.
It's one of the key areas to build a billion-dollar company.
Agreed.
Okay.
In the next 5 to 10.
Well, that's my first question for the panel. Yeah. We might actually go to the one of the questions here. So I'm going to ask the sort of panel a question, and we are going to pose a question to the audience. So the next big thing. So this is all about, and I'd love to think geographically as well. Where is it and why? But where do you think that next big $10 billion company will come from?
I think it's going to come from data. I'm not sure it's going to be a financial services company per se, but it's going to be data-driven. I'm working with a couple of companies in that space right now, and what they're doing is scary. But it is going to happen, and it wraps around all of the RegTech stuff. It then has impacts into bureau documents, credit scoring, alternatives credit scoring. That to me is an area where you could really see it happen. But I fear that you talk about 10, 15 years to develop those sort of businesses. A unicorn takes 9 years to generate. I can see that those sorts of businesses will be kicked off by a VC house, and then they will be, invested to be sold, so that the ultimate, you'll see them get to the $10 billion company, but not as a standalone, but within inside a group of such.
Can you see any sort of these kind of companies coming out now? Looking at the data point, to Andrew's point?
Well, hopefully we see tons of them. But I would tend to agree, and I think probably it's in something like RegTech, something truly boring, and that creates a lot of margin in a very short period of time.
Yeah,
because that
takes the pain away.
In terms of it will take, for a new financial services startup, it will take 9, 10 years, whatever, to get to scale, or longer. But for a company that all of a sudden is going to remove pain for all the people in this room, that'll happen like that.
I mean, we were talking about China and Asia before. Geographically, where do you think this growth is going to come from, or the billion-dollar company?
Yeah, I mean, I think the chances are it will come from Asia because, at the end of the day, whether you call yourself a product or a platform, it's about getting to scale, and you've got obviously demographics on your side when it relates to sort of markets such as China and India. But in terms of the next big thing, I agree. I mean, I think I look at things like RegTech, it's non-discretionary. You've got to comply. It's a ticket to the game. But I think if we look sort of further ahead, I think what we've observed in terms of what's driven investment is where are the profit pools that are most easiest to access with smart technology. And that's why there's been a lot of investment into payments as an example. But the reality is the biggest profit pools in the industry are in secured lending. And I think that for me, the real big battleground, it won't be immediate, so I don't think it's the most immediate next big thing, but I think the one that's going to be the most hotly contested will be around mortgages. And certainly from a corporate perspective, the area that is of most concern, perhaps won't be as immediate, but certainly the one that certainly keeps executives awake at night is disruption that will occur around mortgages through digital propositions. So I suspect if there's a fintech company that can enable FIs to respond to fundamentally transforming the mortgage process, then I think absolutely there's $1 billion plus play there.
I mean, we're the Aussies sitting at the table, but we can certainly say that is the asset class in Australia, and where the battleground is, who's going to win that will rise to the top, of course. Victor, do you have anything to add there?
Well, 10 billion is a big number, but let's say billion. So we talked about regulation. The nice thing about it is it's a huge growth area, as everybody knows, plus also it's very manual at the moment. I mean, the number of people doing regulatory compliance in some of these, in financial, as you all know, huge. And so the application of AI and ML capability, you don't really actually need such great machine learning capability because the data sets are enormous.
Huge, yeah.
And the problem is enormous. So if you just make a dent in it, you can build a company of real size. The second area, which we haven't mentioned yet, if we were going to put bets, would be around financial inclusion. I mean, some couple of sessions on Africa, and as we're doing a fairly large round in Africa, we have some knowledge about this, but market's just getting going. High growth market, very complicated, very difficult to do, but there are several billion-dollar sub-Saharan African mobile payments-driven companies. M-Pesa is just the beginning. And that market is wide open, because if you look at the size, there's M-Pesa, and the number 2 guy is like nothing. And you have 700 million adults. The third area is people talk about InsurTech a lot. Most of it is just veneer apps, but there is a real opportunity to build a digital insurer for the ground up, but people are doing it. But to build a digital insurer is a long-term proposition, but you can do very, very interesting things, and you can completely reprice risk, completely. But what people are doing is, of course, the expediency, which is taking other people's products, rebadging it, reselling it, which doesn't really do anything to the industry. When you get one, I mean, Ping An writes $100 billion worth of premiums a year.
Yep.
So, enough said.
And they themselves have already spun up 2 unicorns.
So,
I think this issue of financial inclusion is an interesting one. We often sort of cite the emerging markets. I think there's an opportunity emerging, be a threat as well for a lot of the FIs in the room around the developed markets and what we're observing from the perspective of what digitisation and automation is doing, not just in financial services, but in most sort of corporate economies, is that we will see increasingly more people displaced through that automation. That's a reality. But we're going to see the rise of the so-called gig economy or freelancers, and these will be highly skilled people that won't be employed by one FI for a number of years, that they will float around task-orientated, project-orientated, hired guns. But the reality is, if you look at most credit models, whether it's banking or insurance, it is all built upon lending money to people that have got stable forms of employment, not people that are a part of the so-called gig economy. So it really brings rise to the question, how are FIs going to underwrite credit in a world when they've got very traditional models that need to flex to be able to underwrite credit to this new class, which the reality is, over the next 5 to 7 years, will invariably comprise 40% of the employment market. So I think, to your point, Mike, this notion of alternative credit and thinking about big data that informs underwriting, I think, is going to be an important element of ensuring that we're not building this element of financial exclusion in developed markets.
And one of the ways that we look at it, one of the ways we communicate about our fund is we say we're financial services for the rest of us. And that's not to say that we're going to disrupt banks, but we do want to disrupt cost curves of serving. So we'll often look at a traditional financial inclusion market, Africa, and say, well, look, if this company can make a profit delivering financial services to some portion of the 3 billion underserved, and then they take that same platform and they move it into a developed market, then they're operating at a much lower cost base. And we've already seen a couple of those experiences in our portfolio. Same thing goes with serving the gig economy. We have 4 different gig economy companies, all of whom are partnering with financial institutions to try and help them reach that market. So 100% agree.
I love the financial inclusion space and sort of social change that some of these businesses are making. I want to raise a question with the audience, which is, do you predict investment will grow over the next 2 to 3 years? We're going to do an old-fashioned raising of the hands, and then I'll ask the panel to discuss this one just quickly. So investment growth over the next couple of years, does anyone, who thinks it will increase? Most people. Decrease? No one. Stay constant. Okay. So I think we're looking at increase. Would you like to add a little bit of a view there?
It just keeps going up.
Does.
Yeah. It's on the up.
It's grown.
Well, that's good. It keeps us all in a job.
10x in the last 5 years to 50 billion or something like this. And although on a quarter-to-quarter basis, you sometimes see drops as people sort of digest the investments that have been made, every next quarter seems to be a record on the prior year. So again, we think it's still.
And I think
growing.
we've just cited those areas that growth will.
I think it's a
occur in.
diverse market. I mean, there's so many different categories of fintech. You've got the horizontal plays, the verticals. No doubt within that we'll see a mix of increase, decrease, hot money around particular areas, and that will then either resolve itself or otherwise. But I certainly think overall it'll increase, but it'll be interesting to see observe, particularly in areas such as alternative lending that we've spoken about, or payments.
Yeah, that's
what sort of trajectory that's going to lead to over that medium-term horizon.
Well, I think this panel has talked about these new areas where we could really see it in InsurTech.
Well, the thing is also the nature of it. It's one thing to say it's going up, but then if you parse it a little bit, it's starting to shift slowly towards larger rounds. People
Yeah.
are starting to put more money behind people who look like they're going to be winners. And, we're doing more fintech fundraisers than we ever did. And the reason is because more people are raising larger amounts of money. It's commensurately harder for people who've done the first, second round to actually raise that intermediate amount of money. Right? Because you have to fit into, well, we've got 42 fintech companies doing X, why should we give you $5-10 million bucks? So, but the market for 50 million plus fundraisers is actually going up much faster than the total increase in funding. And so it's starting to concentrate slowly but surely.
Yeah.
Thing is, as you said, it's pretty...
moving between sectors, right? Like a while ago, there were more money than you can shake a stick at going after remittances on blockchain, and now no one would ever touch that.
Yeah.
But if you say, I'm doing a capital market stack based on cryptocurrencies, like a lot of people are going to go into that.
Yeah.
Right, so it moves around as each of these different sectors begin to move up a curve.
Yeah, and then there's certain saturation in some areas, which we've discussed, which you kind of maybe would steer away from. We're nearly there. We're nearly at the top. Everyone can go and have a beer or a cocktail in a minute. Last one we thought we would discuss as a group, because it's quite an interesting one, but the biggest misconceptions when it comes to fintech. What are these misconceptions? What's to be avoided? Victor, I started with you. I'll start this one with you.
Misconception one, we can build it in 5 to 10 years.
Yeah.
No chance.
Okay, so longer.
Not one of quality.
Misconception in Europe is that I'm going to float it on an exchange.
Yeah.
Since I've got
misconception two is, I think, the cultural point that, we just combine a bunch of tech people and financial service people and they get it right.
Yeah.
Yep. Yeah. Good luck. Misconception three is that I have a defensible position. So, just an example. People thought, I'll get a digital banking license, build a bank. Well, now in Europe, everybody's getting a banking license, like everyone.
Yeah.
So good luck. You just spent a chunk of money getting a banking license, and it's totally meaningless because 75 other people are getting one. So defensibility is incredibly hard.
Yeah.
I'm going to come at it from the other side, from the financial institution side. Misconception one, Jamie Dimon bought Bitcoin is actually important, but it's not for the reason that you think or don't think. It's because if you look at in the 90s, SMTP and HTTP, what it did was it brought millions of really smart, passionate people into thinking about changing information services. And the same thing is, it's not about Bitcoin, it's about people starting to play with technology to change the way that money is dealt with. And so that's a really important thing, and that's sort of the driver of this trend from behind. The second misconception, I think, is that because you're 150 years old and you have regulatory protections, that your business isn't going to change. Mm-hmm. Whether it's because one of your competitors, traditional competitors, is going to adopt some of these new ways of working, or Goldman, say, is going to go into consumer lending, or say Alibaba is going to be the largest fintech on the planet in only 5 years because they figured out how to use their data better, right? Or Orange gets a banking license in Africa, right? The Lego blocks are being moved around and no one is safe.
Yeah.
The only safety is in taking action.
Absolutely. Yeah. From the corporate view, biggest misconceptions for you?
Yeah, I think the one which I think we're sort of slowly moving away from is that this is a big existential threat in terms of the proliferation of fintech companies. There's sort of near 20,000 globally. I think, to your point, Andy, that I think there's greater recognition that a part of the response to that fintech disruption is working with those fintech companies that can enable some of that problem solving or filling a product gap and helping organisations get to that point much more quickly through partnering, investment and potentially acquisition. So I think that's one. I think the other misconception probably for a lot of fintech is build it and they will come. I think one of the biggest things is just category awareness. So you look at areas such as alternative lending as it relates to small to medium enterprises, and I think that a lot of players have moved into that market and have done quite well, but when you add it up, it's still very insignificant in the context of total credit outstanding. And I think the biggest issue for a lot of those fintech companies is getting more people aware of those alternatives that are available.
Absolutely. Mike?
Yeah, well, so I want to follow on that because this is another misconception that we run into, is that large institutions think that they for some reason can't innovate. And in fact, it's just a new muscle that they need to begin to work out. So there is hope in that.
Yep. I think that the banks are reasonably smart. You take the old finance platforms and marketplace lending, you look at the big movers who are actually putting money on those platforms now, it's the banks. Why? Because all of a sudden I don't have to worry about the origination cost of the loan, so I'm basically lending wholesale for retail returns. That works. You know, I think Lending Club has like 46% of its investment are banks themselves.
Or,
Or more. Yeah.
I would just add from a fintech investing point of view, perhaps one of the biggest misconceptions is people begin to believe their own valuation.
but we never see that.
Yeah.
Well, there you go. 11 seconds to go. We kept it to time. Please join me in thanking the panel of experts today. Fantastic. Thanks, guys. And now we have drinks. Mike.
Let everyone go. I want to invite you all. We're hosting the In a Tribe cocktail at the aquarium next door. It should be awesome. So I hope you'll all come along.
Yeah, join Mike.
Indeed.
Thank you.
All right, thanks.
Thank you.
Thanks, Mike.
Good stuff.
That worked.
He's going to give me